Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Nice, slow, calm environment in the stock market. Just actually wishful thinking there. It's been kind of crazy, that's okay. You kind of have to expect this stuff. Markets are very volatile. This is an extremely volatile time of year. You're talking about August, and not sure why. August, September tend to be pretty bad months for the stock market in general, but lots of different reasons for that, and I think a lot of those reasons are changing a little bit, as most things in the market. Are you, if you're really concerned, I'm not sure I would be. I just don't think that it's all that bad, actually. I think that you've got problems. There's definitely a lot of problems with trade right now. It's mostly rhetoric and a lot of talk. When you look at the actual economic impact that these tariffs would have, it's not that significant. But what it is psychologically, it's alarming to people. Psychologically, they're getting upset. People don't like surprises. Investors particularly are unfond of surprises. And so you shock somebody with something and they respond, particularly when there's money on the line. So one of the things I like about this current market is how low the valuations on stocks are. Actually, they're right around where they should be. It's not higher. It's not much lower. They're right around where they should be. Certain areas are actually more undervalued than others. So that's kind of neat. Technology is actually done extremely well and still doing well. Probably going to continue to do well. And why? Because, that's basically the story of the entire world, for the past couple hundred years. New technology comes out and we make a leap. Things get easier. I promise you, things are easier today than they were in 1776. I promise you. And you know why? Technology. Technology has made our lives so much easier, and it's going to continue to do so. We're on the brink of a major shift in the way that we do things. If you think about it, how major of a shift was it going from a horse and buggy to an automobile? Big shift, right? How significant was it to go from canals, where the mule might walk a couple miles an hour, to a train? Pretty significant. It propelled us ahead. It created jobs. That's where we are. That's where we are now. The next phase is significant. The stuff that's coming out from technology is mind-boggling, and it's pretty good. I like it. I really wouldn't be too concerned about what's going on right now in the stock market. If you are concerned, you probably have too heavy of an allocation in stocks for your profile. And I talk a lot about this on all my shows. And, there's a risk profile. There's the risk that you probably need to be taking. There's the risk that you are taking. And oftentimes those things are not the same. But then, there's actually the risk that you can tolerate. And sometimes where I find people have the most difficulties when they need to take a little more risk than they're comfortable with. Well, that's a tough one. That is tough. If you have to take more risk than you're comfortable taking to try to maintain your lifestyle, you're just not going to be very comfortable. My suggestion in most cases is that you try to stay true to your lifestyle and just dial down the risk. You may have to cut back. Nobody wants to hear that, but that in some cases that's the reality. In a lot of cases, though, people are fine. They're just fine. If you're fine with stocks that fluctuate, they fluctuate kind of a lot, like a lot. You'll hear the standard fluctuation. I've seen that term thrown about now by some of the bigger financial institutions instead of standard deviation because I knew people didn't know what that meant. So they said standard fluctuation of the stock market's about 16% a year. That's academically and mathematically that's true. It's a little misleading, I think, because people interpret that as meaning, well, the stock market's only going to be down 16%. That's actually not what that means. That's really not what it means. What it means is that from the long-term average, somewhere between 8 and 10%, depending on the period that you're looking at, stocks will normally fluctuate around 16% around that average. So you're really only talking about a minus 8% and a 16% plus 8% is 24%. So you're talking about up 24 or down 8. And 2/3 of the time, it'll be within that range somewhere. Isn't that really helpful? I'm teasing. Kind of. By the way, it'll stay within those ranges. It'll be either minus 8 or plus 24 about 2/3 of the time. Boy, is that helpful, right? But see, they don't want to tell you that because they know you're looking for a hard answer. So they say, well, the average is 16. Yeah, okay. 16% away from the long-term average. Long-term average is, like I said, it's between 8 and 10%. That depends on the period that you're looking at. So anyway, it's hard to get used to a lot of fluctuation. If you're going to have a total return of more than 4% a year, you're going to have to take some risk. I mean, and most people look at the amount of risk that they have to take if they are familiar with the kind of risk that they're going to have to take, and they go, wow, that's a lot of risk for a 4% return, yeah? Your alternative is less than 2% on a CD. And I think there might be a couple CDs out there paying 2%, but there's nothing that's quote-unquote safe that's paying more than 2% right now. You can't get I can't believe I just sounded like George Bush. 2% right now. I'm just kidding. Kind of. But anyway, if you go and look, to get more than a 2% return from something that's safe, it's just that it doesn't exist. It's not out there. If you're getting more than 2%, there's risk involved. There's got to be risk involved because the safe stuff, that's basically all they're paying. In fact, let me go to the Wall Street Journal. Oh no, they are constantly changing their website around. What is the matter with these people? I know what's the matter with them, actually. They need to get you to move around on the website so that they can maximize the data they get for, charging. They charge based on the views. And I won't even get into that right now. But bottom line is you can go to the market data section on Wall Street Journal, and it'll show you a lot of different stuff where interest rates are. And now that I go to the markets data, that's been changed. I have to click on the bonds now. So the 30-year bond is paying 2%. The 10 years, 1.5. The 1 month Treasury bill is 2%. Now, this is what people are talking about when they say inverted yield curve and how that's been a big, I can't tell you how many times I've had people calling and asking about the inverted yield curve because that's, it's been in the news quite a bit, and that's fine. So inverted means normally the longer that you hold something, the more interest you get paid for agreeing to leave your money invested for a longer time period. So when they're paying you more on a 1 month Treasury bill, which now is paying 2%, then they're paying you to have a 10-year Treasury note, which is 1.5%. That's called an inverted yield curve. You're getting more for the short than you are for the longer time period. It's not supposed to be that way normally. Normally, you're supposed to get less money because you're not tying your money up for quite as long. And you've got all these people coming out and saying, yep, that's going to lead to recession every time that's happened. Well, let me tell you something. That actually stayed that way for more than a year, more than one time, with no recession. So the accuracy of that's not very good. It's just not a very good indicator. So And unfortunately, recessions are really difficult to predict. I think it's, I forgot who it was that said it, but anyway, and I changed it around anyway. Economists have correctly predicted 9 of the last 2 recessions. So somebody's always talking about a recession coming. And if you keep saying that, it's kind of like a broken clock. You wait long enough and it'll be right. And recessions are part of the normal activity of the stock of an economy, actually. And I would be really worried if stocks were significantly overvalued. I'd be really worried if banks were coming back in. Banks were talking about their having to increase their loan loss provisions. That's a problem. That hasn't been appearing yet. That stuff hasn't shown up yet. Will it? I don't know. And quite frankly, neither do the banks. If they knew that some of their loans were going to go bad, they would not have made the loans. But think about that. It's common sense. How else would you know? I mean, why would you do that? I can think of some people who maybe there's a plot to get rid of a bank. I'm just kidding. So the loan officers all get together and say, we really don't like this CEO. I'm sure that never happened, by the way. But anyway, it's kind of funny to think about. So when you're looking at 30-year bonds paying 2%, 1-month bonds, bills, treasury bills, you know what the difference between a bill and a bond is? It's the length of time. Okay, so a bill, 1-month bill, 2%, it's actually 2.06. The 30-year is only paying 2.02. The 10-year, so this is actually it's funny. It's like a big wave, or actually a bowl. The short-term interest rates are higher, then they go down. The lowest shorter-term interest rate looks like it's about 1.416, the 5-year. The 10-year is 1.5, and the 30-year is 2.02. So the 30-year is actually less than the 1 month. And that's what they mean by inverted yield curve. The shorter-term bonds are actually paying slightly more than the higher-term bonds are. And it's supposed to be the other way around. So not a really good indicator. By the way, I forgot to tell everybody, you can. We have a seminar coming up here shortly. We're going to be talking about this type of thing, the trade disputes, what kind of impact they will really have long-term on your investments, and what you can do about fluctuating stock prices without hurting yourself. There are things you can do. The main thing is to kind of understand that stocks fluctuate a lot. They always have, they always will. So try to keep your exposure down. I'm going to show you a couple of ideas that you can use to when you're rebalancing your portfolios. Basically, general rules of thumb that we use at Bullington Capital. And there's no cost to attend. Seating is limited. We're holding this at the Corporate College East. If you don't know where that is, you can actually, there's when you sign up, I think they bring you to a map to it. But it can, and if you can't, I've got the address right there. You can just Google it. So feel free. That's Bullington Capital Management if you want to sign up for that. That's going to be Thursday, September 12th. It's going to be 6:30. And, we'll take a look at it. Trade disputes are things that you're going to have from time to time. And they do have an impact. The impact, I don't think, is probably all that well understood, mainly because it can't be. They're never done the same way. Trade disputes I've never seen 2 trade disputes handled in the exact same manner, ever. So maybe I'm wrong. Maybe there are some that are out there, but they always have slightly different impact. The impacts potentially should be that the consumer ends up paying higher prices. If it escalates too far out of control, prices can go up a lot. If prices go up a lot, that's hard. That's really hard on stocks because the cost of materials goes up. If you're importing materials, I'm pretty sure we don't import a lot of materials from China. I'm sure China imports their net importer for materials, and they export a lot of finished goods. Yeah, but anyway, we're going to take a really good look at that, deep dive. What kind of things can you do? What kinds of investments in that environment have a tendency not to drop quite as much. That can be a big deal. We try to construct portfolios based on that, by the way. We're trying to, it's not necessarily the highest returns, and they won't be because we're being defensive with it. You're trying to locate higher quality stuff, so that makes a big difference. There are certain factors that over time have a tendency to make a big difference in how your stocks will perform, your stock funds. And by the way, this is all, what's interesting about this is it's really changed over the last few years. A whole lot of stuff has changed. Some things that used to work really well, they still work. They just don't work quite as well as they used to. And some things that didn't work well at all work a whole lot better than they did. And that blows my mind. I'm happy about it, actually, because the sad part is it takes you a while to adjust because you don't know that it's going on until you've got enough proof, which means that something's outperformed for a while that hasn't performed as well in the past, and then something that had performed well is lagging a little bit. It's not like you're losing money. You're just not making quite as much money, and that you don't figure that out until it's already started happening. Nobody sends you a crystal ball that works from Amazon. Just kidding about Amazon. They don't have crystal balls that work. But nobody sends you a crystal ball that works that allows you to project what's going to happen in the future. And I think one of the things I've learned over the years, and I've known this for a long time, it's to kind of stay present. Think about what's happening right now. Try not to predict what's going to happen. Don't worry about what's happened in the past. Just pay attention to what's happening right now. Take a look at how your portfolios are broken down. What kind of investments do you have? How do they perform in a tough environment? Because they don't all perform the same. You're looking at momentum investing. Momentum typically performs better when you're into the expansionary periods, which are typically 2-3 years after the market's bottomed, which means that when the market's bottoming, when it's going down, forming a bottom, those things are going to get whacked. And we'll have to figure that out, or figure out why when we come back from these commercial messages. You're listening to Bill Bullington right here on 1420. Stay tuned.
On the side of the road where a mother lost a son, how could she know that the morning he left would be the last time she'd trade with him for a little more time? She could say she loved him one last time and hold him tight.
Direct.com.
And we are back. You're listening to Bill Bullington right here on 1420. I'm here every Saturday morning from 11 to noon. Feel free to call us if you have any questions or comments, 216-901-0945. Also go to my website if you want to sign up for that seminar or just set up a get-to-know-you meeting. If you've got questions, you just want to talk about your investments, or you got some financial planning you want to discuss, feel free. Do the very best we can. I have been getting inundated with calls this week, as you can imagine, with the markets dropping the way they have. And you know what? What's really interesting is after you get used to it for a while, when you really look at it closely and you study it, you go back a few years, you look at this stuff and you're like, well, yeah, it's not out of the ordinary. And it's only out of the ordinary to people that have never seen it before, or maybe, they weren't paying that close attention. And those are, very good reasons, because most people have normal lives. This is not what they do all day, every day. And at some point in time, though, people have a tendency to start to pay attention. And then they start to learn some things that they didn't know before. They were happening, but it's new to them. And then it becomes very disturbing and upsetting. And if you watch too much of the news, that's going to be really upsetting. The actual news that it's going to move markets typically comes out kind of unexpectedly. And oftentimes the market will move in an opposite direction that you thought it was supposed to. So that's something that you get used to when you've been doing it for a long time. And you learn not to rely on the expectations that you develop by listening to the news. And so I think that's interesting. And I know the novices go, well, if you're not going to rely on your expectations, then what do you rely on? Well, you got to go back and rely on the math and the research that you've done in the past. Yes, this is not new. In fact, what's really fascinating is if you look at the S&P 500 and you go back and look at a chart, it broke to a new high in September of last year, right before selling off about 20%. So it breaks to a new all-time high, and then it rewards everybody for getting in by dropping 20% in a few weeks. Woohoo! That's fun, isn't it? So the expectations when you go to a new high is a lot of people think, well, this is it. It's going to go higher. And then it turns around and gives you a black eye. And it recovers over the next few months, and it recovered in almost the same time that it took to go down, which I thought was pretty interesting. It's pretty symmetrical, the decline and the recovery. That's a little unusual. Anyway, makes another new high, turns around and drops about 10% from peak to trough. Let's see, I'll tell you exactly what it was. I'll take it back. It was about 8%. So actually, it's just a little over 7. So that's what you get for breaking out to a new high, getting everybody excited. Turns around and drops 7% in about 8 weeks. Woohoo! Then it bottoms from there, turns around, takes off, and makes another new high. And by the way, these new highs are not very far away from the old new high. And it looks like we're in the correction process now of that last rally. So it's pretty funny, I think, because you know what? And I know, I guess funny is a bad word. It's expected. I expect that, and if you've been in stocks for any length of time, you have to learn how to expect the unexpected. And the reason I spend so much time, by the way, talking about stocks is that when you look at interest rates and you see how low interest rates are and how difficult it would be to be able to live off of something that's got a guarantee, you can get a CD that's paying around 2% right now. That's taxable income. It's taxed at your highest marginal rate, by the way. So 2% on $100,000 is only $2,000. 2% on $1 million is only $20,000. Now think about what I said. 2% on $1 million is only $20,000. That's not a lot of dough. By the way, you have to pay tax on that. And depending on the tax bracket that you're in, it's going to be, could be $4,000. So now you've only got $16,000 after taxes. If you're in a high bracket, let's see, 16,000 divided by 12, that's $1,300 a month. $1,300 a month if you're putting all your money in a short-term CD and you've got $1 million. By the way, to spend more than $1,300 a month means that you're going to have to spend principal. So that's why I've been spending most of my time over the last couple of years talking about stocks, because I don't think you have a choice. I think if you're going to have a return that's higher than 4%, 4% is pretty tough actually these days. But if you're going to have that return, you're going to have to invest some of the money that you have in some sort of stock funds. They just think that's one of the only options that you have. So, I see the phones lighting up a little bit. Hey, if you'd like to call us, the number's 216-901-0945. And I'm going to go right to Mike. Mike, you have any a comment or a question?
Bill, good morning. How you doing?
Good.
Good. Negative yield.
Right.
I think Germany floated a 30-year bond this week, and people actually bought it knowing that they were paying, I guess, to store their money.
Right.
And I want to parlay that into what you were just going over. If in fact inflation in the United States is 2%, and you have 2% for a 30-year or a 10-year bond, and you're paying taxes netting maybe 120 or 140, aren't you accepting a negative return for that 10-year period of time as well already here in the United States?
Yes, you are. Very astute of you to point that out. I think a lot of people don't think about that. I know they don't think about it. I'll ask people at seminars. I don't do this anymore, but I used to ask people to raise their hand if they'd rather see 15% inflation or for 5 years or see their money cut in half. And everybody raises their hand. I'd rather see 15% inflation. Okay, I'd say, 15% over 5 years. You realize you are in the exact same shape.
Yeah.
If prices double and your money doesn't keep up with that, even if if your prices double and your money doesn't keep up with that, or if your assets get cut in half because you've had a stock market crash, you're actually in the same boat. So that's a very astute of you to bring that point up. Yeah, there's a negative yield, negative real yield. That real means adjusted for inflation. So right. When you're hearing these guys talk on television or you read an article in the journal and they're talking about real rates of return, they mean inflation adjusted. So the inflation adjusted returns have been negative for quite a while in the United States. I'm not a big believer in CPI, Consumer Price Index. I think prices have actually been going up faster than the CPI. The CPI is a government statistic, and if you owed $20 trillion and got to set your own interest rates, what would you do?
One other quick question here, just and I know that you're in the business, and I'll formulate the question carefully. Do you think the bond trade at this point, if you're buying fixed income, if you're buying a 10 or a 30-year bond, do you think it is a crowded trade?
Oh, I can't imagine that sometime over the next 20 years that interest rates are still negative. Now, maybe they will be. I could be wrong. But I just can't imagine things getting somewhat back to some sort of normalcy. And when that starts to happen, when those bonds are going to drop like rocks. I mean, nobody's going to want them. Maybe China will. I don't know. But China will take everything.
And I don't know if your general audience knows, if interest rates went from 2 to just 3% on a 30-year bond, what happens to the $10,000 hypothetically that you just bought a 30-year bond with at 2% from the Treasury? Yeah. What happens to the value? Can you maybe expand on that? And I'm going to let you go. And you have a great show, and I appreciate your time.
Oh, thanks. Thanks for calling, Mike. Yeah, so what would happen if interest rates on a long-term bond were to go up by 1%? You would see a 15% roughly. You should see a 15% decline. Now, having said that, that's how the math works. So if you put $10,000 in there, it's a 30-year bond. It was guaranteed by the United States government, but if you try to sell it, they're only going to give you $8,500. Okay, you can sell it, but you're only going to get $8,500. You paid $10,000 for it. Let's add some zeros to that. If you paid $100,000 for it, you're only going to get $85,000. If you paid $1 million for it, you're only going to get $850,000. So that's $150,000. Okay. So, but that's if it worked the way it's supposed to work mathematically. What's been nuts is that there have been countries for a long time that'll come in and pay more than they should. So the bond prices have been actually slightly more stable than they should have been. Because when you're looking around the world right now, according to what I just looked up on Google, I'll have to go back in and make sure that I double check this. Anyway, in Germany, the 10-year bonds are a minus 0.69%. That's not supposed to happen. Okay, Belgium, France, the Netherlands, Denmark, Sweden, and Spain all have negative yields on government bonds. They're essentially charging the public to hang on to their money for them. That's what they're doing. They're charging the public to hang on to their money for them. This is when people say it's different this time, they have no idea. It is really different this time. For governments to charge you to hang on to your money instead of paying you interest for borrowing your money is a wow, it's not expected. So, and this is where I think when you're looking out there at the seminar, I'm going to have a special list of funds for people who are focusing, their stock-based funds, who are focusing on companies with quality dividends, not just a dividend, but a quality dividend. And the yields are higher than the yields on bonds. Okay? I'm going to give you a couple of ideas for free. You don't owe me anything for that. Just sign up, show up. And you don't even have to come in, go to the seminar. You could actually call and set an appointment if you'd like. I will tell you, my schedule's been filling up since the market's been fluctuating like this. I can only see a certain number of people a day. And I do have a lot, but you can always come to that workshop. You can call in and set up an appointment to come in and talk about this kind of stuff. Yeah, I know it's probably weighing heavily on your minds. But by the way, you can also call in here today, 216-901-0945, just like Matt did. I'm going to go right to the phones. Hey, Matt, how you doing?
Hey, Bill, how you doing?
Pretty good.
So I don't know if you can maybe go into explaining a little bit more about investing in bonds. And I'm as of now, I'm still kind of blessed. I'm a government employee, and so at some point I will have a pension until the government screws that one up.
Oh, you'll always have a pension, by the way, because they control this thing called the money supply.
Yeah.
And they can literally print money and pay the bills. Now, that would be horribly inflationary, but it would be better than the alternative. But so you'll never be out of money.
So I've kind of looked at that as kind of my, conservative monthly payment, and whereas with my other investments, I've been a little more aggressive for better long-term growth. But, the problem is with what's been going on with the bonds, I've kind of looked at it like, well, I'd rather, generate income from even, a low CD or like closed-end funds or writing covered calls or stuff like MLPs to generate a little more income than to even waste time with bonds. And I don't know if you can weigh in.
Yeah, that's actually one of the reasons I was just bringing this other topic up. There are a lot of alternatives that income generating ideas that you can use. There are a lot of dividend paying stock funds that use some math to select the stocks that I really like a lot. I like it a lot.
Right.
Makes a lot of sense. And one of the
I remember. I remember being at one of your events at corporate college, and you talked about the dividend paying your fund. Like the top 50 dividend paying, and when things got out of whack or funky, you realigned it. So.
Yeah, now there have been that strategy, by the way, has been knocked off so many times.
Yeah.
There are so many. So it's actually a little easier, and I'll tell you why. Because when a fund is doing that on your behalf, you don't see the stocks that are moving. Stocks are still stocks. They're extremely volatile, even the ones that pay dividends. Yeah.
Correct.
When you see that, it's a little disturbing for a lot of people. And when you're owning those stocks yourself and you rebalance the portfolio, you have to report all those transactions, all those little the capital gains that you're making. You offset against losses, but you have to report everything, and it makes your tax return a lot longer. So now that there are funds that are doing the identical thing, some of them are exactly identical, but some of them are adding some other attributes I really like a lot. Like the companies have to maintain a certain level of profitability. That makes perfect sense to me. And so there are a lot of them out there now, and you can put together some pretty good models for your portfolios. I've got them. I called it my Department of Labor model because they came out with these rules a couple of years ago and said, "Hey, you guys had better adhere to these rules." And then they didn't publish the rules for several months. And if you don't follow the rules, we're like, well, can we see the rules?
Right.
Then when they finally came out with something, about 18 months later, they changed it. Or they dropped it. But, hey, man, I got to take a real quick commercial break. You can either hang on or I'll just probably see you at the seminar.
Okay, thanks, Bill.
All right, have a good day. Hey, you're listening to Bill Bullington. Stay tuned. I'll be right back. Well, welcome back. This is the final segment of today's Bullington Capital Report. I'm here every Saturday morning from 11 to noon, and feel free to reach out to my website if you'd like to get in touch with me. It's bullingtoncapital.com. I'm going to spend the next few minutes talking about a service I've been talking about for probably years now, and we're finally getting it out there. It's interesting because we've gone through so many iterations and so many setbacks, government regulations forcing me to stop and recalculate everything I do in my business, and then having them change them 3 times in 18 months. That was brutal. That's the one thing I will say about this administration. They kind of just left everything alone. They really didn't get involved. But whether that's good, bad, or indifferent, I don't know. Last 18 months, well, actually, last 2 years, they stopped about 2 years ago. They stopped a lot of the activity that was going on. So it's made it a little easier. And what I am going to be doing, it's called, the website's going to be Look Out for the Bullets website. There's a specific style of investment management. You know, there are actually lots of different styles. This is very specific. It's called momentum investing. And that's what the website's going to be dedicated to, momentum investors. What is momentum investing? Well, momentum investing is looking at price movement as one of the leading indicators, so to speak, that we're going to be paying attention to. So we're going to look at price movement more so than things like sales and profit margins, that kind of thing. That's more of a value-oriented approach. One of the reasons I'm telling you not to do this one of the reasons I describe this as a particular style, because that's what it is. It's one style. It's not really suitable for everything that you do. Maybe if you're 20, you're really young, you don't have a whole lot of debt, you got a lot of time on your hands, then yeah, you could do the momentum thing with all your money. You'd be taking a lot more risk. I'm going to teach you how to handle the risk on the website. It's actually a lot easier than you think it is. It's significantly easier, especially today. You know, a small investor does have an edge. That doesn't guarantee that you're going to be successful doing this. It just means you have an edge. And your edge is speed. You can move faster than a big mutual fund can, or a hedge fund, or an exchange-traded fund for that matter. Like the exchange-traded funds, they just move whenever they're told to because they're being run by a mathematical model. But that being said, you have a little advantage. I'm going to show you how to take advantage of that. It's not easy. It is simple. Big difference between simple and easy. In fact, I'll give you the highlights right now. The bottom line is, if you want to make money in stocks relatively soon, you want to be looking at stocks that are going up really fast right now. Does that make sense? If you're going to try to make money quickly in stocks, wouldn't you want to go to those stocks that are going up right now? Why would you want to be looking at stocks that are going down or getting crushed right now? I'll tell you why. Because you're a novice. Because you don't know that if you want to make money sooner rather than later, you should focus on those stocks that are going up right now. That's a big revelation for a lot of people. Huge revelation. So I'm just going to leave that alone. That's the first thing you do. And I call it fishing in the right pond. You know, if your goal is to catch a whole lot of fish and you see 10 ponds out there that a farmer owns, you maybe want to talk to the farmer and ask him which one he puts the most feed in. Or if he stocked one of those ponds more than the others. So we're just fishing in the right pond. Basically, we're going with stocks that are moving up quickly right now. The next thing we're going to do is learn how to manage the risk. And that's the most important part of this whole thing. And actually, I would say any strategy that you're using, you got to learn how to manage the risk. And it's not that complicated. It really isn't. Having said that, I think, there are a lot of challenges psychologically. I'm not even going to beleaguer those points because it doesn't make sense to do that. I've been doing this for so long that I've noticed that people have a tendency either to get this right away or they just don't get it. And they never get it. Now, you could be one of the few. I didn't get it at first, but I had to get my head beat in the stock market and go, man, I am doing this wrong. This cannot be right. So I was so determined that it opened my mind and let me listen to what I've been talking about and using since then. Now, I do this with slightly less than 20% of my money. Think about that. Slightly less than 20% of your money. So I'm going to recommend that you do the same thing. And I'm going to leave that subject right there and just go into a lot of the stocks that I saw come up on the scans yesterday. Because yesterday was a tough day for the S&P 500. If you weren't watching, in fact, over the past couple weeks, market's down. Well, probably. Hang on, I'll tell you exactly what it's down, or not the market, but the S&P 500. All right, it's down about 6%. Just in the last 2 weeks, it's down about 6%. So it's been a pretty tough environment. I still run the scans because some stocks may actually buck the trend. They're typically not that many. But when I ran the scan yesterday, there was a clear sector that was bucking the trend. And those are gold stocks. Gold stocks were bucking the trend yesterday. Now, a lot of those gold stocks have been in a pretty good trend for a few months now. So that's interesting. And a lot of them are up, 40, 50% over the past 4 or 5 months. That's pretty interesting. So what do I make from that? Well, personally, my observation is that there's a lot of fear. When there's a lot of fear in markets, people have a tendency to buy gold stocks. They just do. Why? Well, because I think some people see it as a place to hide out. Maybe gold won't be as affected by all this. Maybe a lot of the things that are happening are inflationary, and they are, by the way. When you're doing tariffs, countries are fighting over tariffs. Who gets to pay for that bill, for that argument? The consumers. So you start throwing taxes on top of items that are coming into the country that you're importing. Guess who gets to pay those taxes? A consumer. Manufacturer's not going to take that on the chin. Are you kidding me? If I were a manufacturer, I'm not taking that on the chin. I would say, I'm sorry, but your government decided to tax my goods. So this is the new price. And that hint of fear gets these stocks rocking. I mean, I go down the list. I'm not even sure if I'm pronouncing this right. Agnico, Eagle Mines, the symbol is AEM. I've seen that stock for years. First Majestic Silver, AG, that came up on the scan. Alamos Gold, that came up on the scan. Those are the first 3 stocks. Yamana Gold, that's the first 4 stocks. First 4 stocks that come up on the scan, they're all gold stocks. And by the way, they look like technology stocks breaking out of basis, a lot of them, which if you don't know what that means, don't worry about it. We'll talk a little bit about it at that upcoming seminar. Beta Gold Cord, don't know who they are. Carbon Black was actually a technology stock that came up on the list that I had purchased the day before. It's pretty interesting. It gapped up and closed at its high of the day, 6.33% in one day. Sweet. Anyway, Core Mining, now the gold stocks. Cardalytics, not sure what they do, but I think if I were to guess based on the name of the company, it's probably something to do with payment systems. Sprott Physical Gold and Silver Trust, CEF. Eldorado, do you realize there's only been 2 companies out of the first 10 stocks that weren't gold stocks? Does that tell you anything about gold? I don't know. Is it going to keep going? I don't know. See, that's part of the Look Out for the Bull website. We're going to teach you how to identify what's happening right now. That's a big leg up, okay, but it's not a guarantee. You still have to manage your risk. Would I put all of my portfolio in gold stocks, buy all gold? I would never do that. I don't think that's safe. But would I buy a couple of them? I might. I have a tough time. I will tell you, I have a tough time. Eldorado Gold Corporation, I think, is probably one I might. That would be the next one on the list. I look at the price to sales ratio. That must be publicly. I think they actually produce. I'll have to go back and look. I haven't read about that company in a really long time. I see it come up all the time. But if I'm going to buy something, probably 1 or 2 stocks. because I need to manage the risk, and that's what I'm really most concerned about, is managing risk. Now that I hear the music, boy, I didn't get as far as I wanted to in that segment. So we'll pick it back up next week. You can always give me a call in the office or go to my website, bullingtoncapital.com. Have a good weekend, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.